This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at our own discretion. Hello and welcome to AI Market News by LM. Today we're embarking on a deep dive into the global financial markets, giving us a crucial snapshot as of Tuesday, September 9, 2025.
It is, yeah. It's a truly dynamic mosaic we have before us. We'll be covering, well, everything from the latest shifts in major currency pairs in U.S. equity markets to the macroeconomic indicators that keep us all watching closely. Our mission today really is to distill the most important insights from a stack of diverse sources, helping us navigate these complexities and maybe uncover some truly surprising connections.
Exactly. We're about to unpack some, well, pretty significant market dynamics and the underlying forces at play, and maybe figure out why the market seems to be pulling in several different directions all at once. Okay, let's jump straight into the broad market pulse then. According to various news commentary, it's 5:00 a.m. in New York City, September 9th, and we're already seeing significant movement across the board.
What's fascinating here, I think, is that we're observing a really mixed picture, almost paradoxical. On one hand, global bonds, both sovereign and corporate, they're officially in a bull market. They've surged more than 20% from their March trough. Yet at the same time, U.S. equity markets are just charging ahead. The NASDAQ hitting a fresh record, the S&P 500 hovering around its own all-time high.
Right, even with all those persistent warnings about potential economic slowdowns floating around.
Exactly.
And this mixed picture, it gets even more complex when we zoom in on specific assets, doesn't it? Like, while bond yields globally have entered that bull market, U.S. Treasuries, they're taking a bit of a breath today. Yields are up about 2 basis points. The 2-year yield is kind of hugging 3.50%. But what's truly striking is gold. A traditional safe haven, right? It's simultaneously hitting fresh record highs, trading above $3,600 an ounce.
Yeah, that's really something. And I don't think it's just about general uncertainty. It really highlights a market grappling with two distinct, powerful forces. You've got this strong conviction and a growth-driven tech rally on one side, and then on the other, this deep-seated institutional hedge against maybe persistent inflation or systemic risks. That's pushing capital into hard assets like gold.
Yeah.
So it's less about simple hedging, I think, and more about a fundamental split, a bifurcation of investor conviction.
A bifurcation, yeah, that makes sense. Makes predicting the next major move exceptionally complex.
Absolutely. And look at oil, too. It's up today, even though Saudi Arabia just cut crude prices across the board. That indicates pretty strong buying interest, doesn't it? Taking advantage of that price cut, it's another sign of underlying demand and perhaps those lingering inflation concerns.
That's a powerful point about bifurcated conviction. So, okay, let's drill down into U.S. equities then. Based on the prepared resources, the NASDAQ composite hit a record, and both NASDAQ and S&P futures are pointing higher again today, building on yesterday's upside. But we're hearing some contrasting views that are really making us think about the path forward.
Indeed we are. On one side, you have JP Morgan sounding, well, a cautionary note. They're warning that we could see stocks tank, especially if this anticipated Fed rate-cutting cycle truly begins. They're suggesting a classic sell the news scenario, basically arguing that much is already priced in, and they seem concerned about wages ticking up if rates go down, fueling inflation again.
Right. It definitely feels like a tug of war. For us trying to make sense of these, well, vastly different outlooks from giants like JP Morgan and BlackRock, how do we synthesize these views? Is there a prevailing narrative emerging, or is the market truly this fractured? Because you have BlackRock saying shares are not dead and investors are actively repositioning.
That is precisely the challenge right now. While historical patterns do suggest the market performs well during rate-cutting cycles, I think the average return is something like 20% compared to 16% in other periods.
Yeah.
The crucial distinction this time might be that the market has already priced in so much. That could create that sell the news scenario, maybe unlike previous cycles. And you even had the CEO of Goldman Sachs, David Solomon, signaling he doesn't see a pressing need for the Fed to rapidly cut rates. He noted risk appetite is at the more exuberant end of the spectrum.
Yeah.
Meanwhile, the market's pricing in more than 3 Fed rate cuts by year-end. A 25 basis point cut in September? Well, it's almost certain. There's even like a 10% possibility priced in for a 50 basis point cut. It really seems the Fed's focus might be shifting a bit from tariff-induced inflation worries to potential labor market weakness.
Okay, so what does this all mean for us, as investors looking at our portfolios? We're clearly seeing this tech-led rally, but some analysts are suggesting we look for a subtle shift, maybe towards small caps, value stocks, financials, industrials, rather than expecting an outright collapse. I mean, the S&P 500 is already at 6,503 points. That's essentially hit JP Morgan's year-end target of 6,500 already.
Right. And a critical piece of this puzzle is definitely investor sentiment. According to CNN's Fear and Greed Index, there are signs of exuberance right now. But if you look at the AAII sentiment surveys, those poll individual investors on their outlook, they've shown periods of significant pessimism historically, and often that's been a precursor to rebounds. And remember the VIX, the volatility index, it spiked above 50 back in April and August. Those are levels that usually signal extreme market fear. Now it's much calmer, down around 15.36 according to Finzies, closer to its average.
Calmer now, but the spikes are a reminder.
Exactly. That historical volatility suggests we should probably be prepared for continued swings, as the market tries to balance strong corporate earnings against the uncertainty of tariffs and maybe a cooling labor market.
Okay, let's shift gears a bit. Let's turn to the fascinating world of currencies, especially Euro NED and USD JPY. Based on the resources, the US dollar index is showing a little bit of weight. What's driving this dynamic in the currency markets?
Well, again, it's a complex interplay of factors, much like the broader market, really. The expectation of Fed rate cuts, that's putting downward pressure on the dollar. Plus, we saw that weak employment data, which also contributed to its decline. Meanwhile, the euro actually saw a slight pickup against the greenback. And this was even after the French Prime Minister lost that confidence vote and resigned.
Yeah, that was surprising, the euro holding up there.
It suggests that while there's definitely political turmoil in Europe, maybe the euro's underlying strength, or perhaps just the dollar's current weakness, is the stronger driver for now.
So let's talk about that French situation. It seems like it's really heating up. We heard from various news commentary that Prime Minister Bayrou lost his confidence vote. Macron now has to find a new premier, and this is happening amidst pretty serious concerns about France's debt-to-GDP ratio hitting 150%. That's one of the worst in the EU. And their budget hasn't been balanced in, 15 years? Yet the market reaction seems, surprisingly muted so far.
That is the intriguing part, isn't it? The markets have been relatively subdued about the French political uncertainty. You look at the spread between French and German 10-year yields. Yeah, it's at crisis levels, around 76, 80 basis points. But it hasn't exploded higher, maybe because of that broader relief rally tied to expected Fed rate cuts.
Maybe cushioning the blow somewhat.
Possibly. However, a prolonged political impasse over there, or potential snap elections, which sources say have about a 15-20% probability, that could definitely push the spread over 100 basis points, and that would be a significant red flag. So it's certainly a situation to watch closely, especially with ratings agencies like Fitch expected to weigh in soon on France's sovereign debt.
Right, and over in Japan, we're seeing interesting dynamics with the yen, too. Prime Minister Ishiba's resignation has opened the door to a leadership race. And you've got candidates like Sanae Takaichi. She's known for fiscally expansive, dovish monetary policy views. If she were to win, some think that could push USD JPY up towards 150, maybe even higher.
It could. However, there are counterforces. Rising inflation pressures in Japan might limit the next leader's ability to pursue really aggressive fiscal expansion. That could act as a brake on yuan weakening. Plus, Japan's yield curve is already among the steepest globally. Any delay in Bank of Japan rate hikes could put more pressure on it. And then there are the underlying concerns about the government's high debt load and its ability to absorb bond supply. It's complicated.
It really is. And it's not just France and Japan showing political upheaval, is it? We saw news out of Indonesia. The finance minister, who was seen as a guardian of fiscal discipline, was unexpectedly replaced after there's deadly protests. And even things that seem more regional, like in Ethiopia. The inauguration of the Grand Ethiopian Renaissance Dam is sparking significant tensions with Egypt and Sudan over Nile River access.
And while those might seem like local issues, they absolutely contribute to broader geopolitical uncertainty. They impact emerging market sentiment, capital flows in those regions. It all feeds back into the global picture.
So all these global political and economic undercurrents, trade tensions, local unrest, currency dynamics.
Exactly. They all contribute to the shifting sentiment around major currency pairs and broader asset flows. That narrative we're hearing that maybe U.S. assets are becoming less appealing at the margins seems to be gaining some traction. And it reinforces why gold might remain a key play for diversification. Driven by those rate cut expectations, maybe some institutional credibility concerns, and definitely geopolitical risks.
Okay, shifting from the macro picture. Some massive corporate deals are making waves today. This brings us to something truly impactful in the mining sector. Anglo American is set to acquire Teck Resources. This creates a combined company valued at over $50 billion. That's got to be one of the biggest mining deals in over a decade.
It is, and it's all about copper. It really is. With the explosion of AI data centers, the demand for copper is just soaring, and new mines. They take 15, 20 years to come online. It's a huge lead time. So this strategic consolidation, it highlights the scramble for critical base metals. Analysts are suggesting we'll probably see more deals like this in the future, particularly focusing on companies with significant copper assets, as this energy transition and AI infrastructure build-out continues.
Speaking of AI, Microsoft just struck a multi-year, nearly $20 billion AI cloud computing deal with Nebius.
Yeah.
That's a massive win for Nebius, right? A company with NVIDIA backing. It really just underscores the ongoing AI frenzy and the huge, huge demand for infrastructure.
Oh, absolutely. It clearly shows that even the hyperscalers, the big players like Microsoft, are still constrained by AI supply chain infrastructure. We should probably expect more multi-billion-dollar deals like this as companies race to build out capacity. It's a clear signal that AI demand is definitely not peaking anytime soon. And these kinds of investments, they're foundational for future productivity gains across the entire economy.
And speaking of tech giants, we also have Apple's big product launch event later today, 1.00 a.m. ET. The iPhone 17 lineup, upgraded Apple Watches, maybe some Vision Pro updates are expected, but as seen in the provided information, some analysts seem a bit cautious. The stock has rallied significantly already, and there may be some lingering concerns about Apple's AI strategy weighing on sentiment.
Yeah, that's the feeling. Apple stock is trading at a bit of a premium compared to some peers like Alphabet and Meta, around 31 times its next 12-month expected earnings. So without significant new AI features being announced today, some do fear the event might turn into a sell the news moment. However, there's also the possibility of price increases boosting growth. That's a tactic Apple hasn't used extensively in recent years, so it could potentially surprise us.
Interesting. Okay, a couple other quick corporate notes. Dell's CFO is resigning after 2 years. Shares are down slightly on that news. And on a completely different note, the Rupert Murdoch family saga seems to be settled. They've resolved their trust disputes, cementing Lachlan Murdoch's sole control over the Fox and News Corp media empire.
Right, with the other siblings reportedly receiving about $1 billion each. End of an era there, perhaps.
Indeed. Okay, we've covered a lot of ground today, but for us to stay ahead, knowing what's coming next is crucial. Let's take a quick look at the economic calendar, drawing from investing.com and other sources.
Right. So today, Tuesday, September 9th, a really critical data point is due out at 10:00 a.m. ET. It's the preliminary downward revision to U.S. non-farm payrolls for the year through March. This annual re-benchmarking process, well, it could see a significant downward adjustment, potentially by as much as 598,000 for that April 2024 to March 2025 period. And some economists actually expect it to be even lower than that estimate. That will surely factor into the Fed's thinking.
No doubt. And looking just a bit further ahead, Thursday, September 11, we get the crucial August CPI inflation data. Core CPI is expected to rise 0.3% month over month. That will definitely be a major market mover, especially with those lingering concerns about tariff-driven inflation and the Fed's dual mandate.
Absolutely. And for those tracking global markets, tomorrow, September 10th, keep an eye on the 5-year JGB auction in Japan. That'll give us a read on their bond market sentiment. And later this week, as we discussed, we expect those ratings agencies to weigh in on France's sovereign debt. So these events, alongside the ongoing Fed speculation and corporate earnings, will continue to shape market sentiment.
So there we have it, our deep dive into today's market landscape. Full of surprising rallies, political tremors, shifting corporate giants. It's a truly complex environment right now.
It really is. It's such a dynamic period where you have these seemingly contradictory signals, like surging stocks alongside record-high gold prices, but they're all part of the same intricate picture. Understanding these underlying tensions and how they pull on different asset classes, that's really key to making sense of the day-to-day movement.
And maybe that leaves us with a provocative thought to mull over. In a market where historical patterns seem to be challenged, where exuberance is clashing with this underlying caution, how much of today's upward momentum is truly sustainable? And what subtle shifts, as some analysts call them, might we be overlooking that could define the next phase? Definitely something to keep digging into. Thanks for watching. Don't forget to like and subscribe.